Happy Sunday, friends, and happy Mother's Day. I hope you guys are all well, and I hope you had a great trading week. I have to say it was a phenomenal trading week for the Trade Speakeasy, and I hope all of our members enjoyed some of the returns that they were able to participate in. So I hope everyone is well. I will wait for Instagram to tap us in. Can see some people rolling in, but I haven't had the flash at the top that we are live. So I hope you guys are well. For those who have joined us, were you guys able to trade this week? Happy Mother's Day to you too. Were you able to trade this week? Were you able to catch some nice moves? What did you trade? Any earnings specifically maybe? Welcome. We have a busy economics week last week. For those of you who joined us last week, I told you I was expecting FOMC to kind of be a nothing burger, not a nothing burger, but that basically the Fed was in a tight position and likely weren't going to be able to do much more than essentially what they ended up doing, which was basically reiterating that all of the data has not enough negative data has come into the actual hard data. So as long as employment numbers were good and unemployment numbers were low and inflation still could potentially be a problem because of unknown tariffs, then they felt that they needed to be, to continue to wait until some bad news actually came out in the data. And that's what happened. They held rates and they did not signal what they would do in the June FOMC meetings. I think that a lot of members or a lot of people were hoping that there would be a little bit of clarity, but the reality is that nothing has happened in the data that should cause them to be worried. The Fed funds rate is above the 10-year, which is not normal. Normally, you would see that the Fed funds rate is below the 10-year or in line with the 10-year. Happy Mother's Day to you. Well, happy Mother's Day to those out there, and thank you. So, just seeing that the Fed continues to be very cautious. That was really what we were expecting. And I think that's what the market was expecting. That's what the future Fed funds rate was projecting. So I think that, that was all kind of known. Now, this week is an important week. Of course, we had really low CPI and inflation data come in last month. And a lot of people kind of already had expected that, but not at the lows that we saw. That was a little bit more than what had been baked into the data. This coming week, again, we have CPI and PPI, and so that will be really important for everyone to for us to all be cautious about or cognizant of. So the reality is that at the moment the general data is still good, but we do know that there's a lot of information that is pressing us towards recession. So being that we still don't know what's happening with tariffs, of course, we had some good news come out this weekend about the Fed or about Preise meeting with the Chinese officials in Switzerland. Honestly, it wasn't a great look for the United States. The fact that Xi Jinping is in Russia and in long-standing talks with Putin, and that the U.S. isn't engaged in any of those conversations demonstrates that Xi Jinping is obviously much more concentrated on China's relationship with Russia and really couldn't care less about whatever the United States is doing about tariffs. On the other hand, the fact that Preise is having to go to Switzerland to meet with their finance ministers demonstrates as well that China really just couldn't care less about meeting with the U.S. All of that basically means that yes, the U.S. would like to get a better trade deal going with China, but if China is going to be willing to play ball, that is where the question really lies. The reality is that China just knows, they knew that this was likely coming because of what happened with Biden and Russia. So the fact that it was Trump doing it or later Biden doing it really, or Kamala Harris doing it, would have really been irrelevant to China. Now, of course, had Kamala been elected or had Trump chosen a less aggressive manner of dealing with China, China might have been willing to play nicer in the conversation. But the truth is that China has been preparing for this for like 2 years now. So they weren't, sorry, I thought my heating turned on and it's already very warm. I was like, don't put heating on now. So basically, the reality is China has been focused on this for the last 2 years. And so they have really been getting themselves to be really, independent as much as possible from the United States. So even with the tariffs conversation, that has also helped China because it has put pressure on other third parties that don't want to continue buying from the United States while they're unsure of what the tariffs could look like. And that has encouraged new relationships with China to be brokered. Number one being China and the European Union. Something that is unique to the European Union to the United States is that the European Union does allow China to sell things like their EV vehicles and so forth. And so the reality is that, China really only needs the United States for about 3 products: soybeans, fertilizer, and LNG. But all 3 of those they can get from other parties. As we saw last time in this kind of rodeo of tariffs, China shifted most of their soybean purchasing to Brazil, and they shifted some of their LNG to other countries. So overall, I think that, China knows how to kind of find their way. They don't need the United States as much as actually the United States needs China. So how long these tariff conversations will go on this merry-go-round is yet to be seen. But of course, Trump is going to take any opportunity that he can to make the markets feel good. Emotional masturbation isn't really what we need. We need hard data. And the fact is that we just don't have any information yet from China. And the last weeks, every time that Trump has come out or Bissent or anybody has come out and kind of alluded to conversations with China, China has basically just turned around and said, we're not really having any conversations. And the fact that Bissent is having to go to Switzerland, not even to have official conversations with Xi Jinping but having to meet with Chinese officials who are coming to Switzerland for conversations with the Swiss central bank is it's very telling about where the power lies. This week we had great news about tariffs with the UK, and that deal has been set. The reality is that, how much was achieved, how much was significant to the United States, how much was significant to the UK. I mean, honestly, it's just too small of a trading partner for us to be getting all excited about, but it did set a kind of floor in the sense that 10% tariffs is going to stand. That 10% tariffs is going to be a lot for some countries because there had been no tariffs before. So I think that, even though 10% sounds very small because we were talking about 145% with China, the reality is that when you accelerate costs by 10% all at once, that's a lot, especially when you're dealing with a lot of different trade. What it also does is it incentivizes the other party to look to see if there's other trade partners that they could kind of ramp up with that won't cost them that much money. So I think that, the tariffs debacle just is going to carry on. And I don't think that, the UK deal is too small for us to feel excited about. The fact that 10% stays as the floor, I think, is still a bit bearish for markets and for cross-border kind of trade. I think the other thing that was important was the election of Carney in Canada and that conversation, the meeting that Trump had with him. And the big thing is that one of the core issues that Canada has faced is that they want to be an energy empire. But because of the fact that they have one of the highest standards in the world for clean energy, it has caused them to their energy empire to suffer. And Carney, it is the liberal elected leader. And obviously most liberal elected leaders are looking for more green energy policy. And I think the reality is that, Canada was looking at a bit of a bifurcation from Alberta and Quebec. And so in order to unify Canada again, there really needed to be a push for more energy sales and less clean energy pressure. The reality is that the way that Donald Trump went about this conversation with Carney, it is quite clear that by Donald Trump playing the bad guy in the conversation, it allows Carney to essentially say, oh, we need to loosen up some of our clean energy regulations because we don't want the United States to pressure us to do A, B, C, and D. And this actually allows them to generate a lot of income through energy and electricity that they had not been able to do because of their own green energy policies. So all that to say, some of the bad vibes that we get from politicians sometimes is because politicians are also hampered in their own countries from being able to do certain things. And if they want to move some policies forward, sometimes they need a bad guy on the other side of the conversation. And Donald Trump plays that conversation well, that character well. So I think that there's a lot more positive energy behind closed doors between Carney and Trump. I think that Carney was who Trump wanted to get elected. So I think that, don't just see everything as it's being played out on the media. There's always layers to this kind of stuff. So that is positive for tariffs. That's, that we're at least moving forward. But the United States needs to get their best friends on their deals, get the deals done, be able to bank those wins just to give the market some kind of a sense of ease, so that if the indexes are going to take the next leg up in markets. Now, to put tariffs aside, this week is options expiration. It is one of the bigger options expiration months because of the fact that people aren't as positioned really far out the chain as they had been. So, 1 year ago, if we were looking at options contracts a year out, so if, back in April and May of 24, we would have seen, tens, hundreds of thousands of contracts already being structured into the sell in May and go away conversation. And for tax purposes, people like to structure a lot of their options contracts more than 12 months out so that, they can potentially take advantage of long-term capital gains tax structuring. And so, but we've just not seen that. We just haven't seen a significant build out of options contract more than 3-4 months out down the chain. But so last OPEX, we did talk a lot about the fact that we had so many hedges coming off. We were likely to get a really strong kind of blow off top off of that OPEX into the end of month. And we saw that. And then now we've started to see a little bit of a rolling over. The question is, what does this OPEX does? So essentially what's happening is that in this option cycle or this OPEX, we have a lot more downside positioning that is rolling off. And so it's a little bit confusing in that when you have a lot of long calls, the broker has sold the calls against them. They've taken the opposite side of the trade. And to hedge their short calls, they buy shares. And that's what creates that gamma squeeze that people talk about, right? So when a lot of people buy puts, the broker is then selling puts, and that creates an opposite trajectory of the price action. And so essentially, just like in April when we had that kind of squeeze up after all the contracts came off, we are likely to see an inverse situation happen. So right now, I mean, the market is hedging itself. People are concerned. People don't really know what's happening more than 2-3 months in advance. So right now, the way options expiration is set up, it does look like when those contracts close up for this OPEX that we could then see the downside activity. So all in all, normally in May, you actually, even though the saying is sell in May and go away, and that is actually for the end of May, because at the very end of May actually tends to be a positive month. Usually you get about 2.3% in the S&P during the month of May. So most people would be expecting that actually after the May OPEX that you continue to kind of have another leg higher. That is possible, but that is less likely. The way the options are expiring would look more like prices rolling down. And just overall, we've just seen liquidity dry up. When we go to see any of the options positioning day over day, usually we would see really robust, options positioning across the chain. And we're just not seeing that. We're seeing like key strikes that have the clustering of open interest, and then really nothing in between. And that's why you're seeing a lot more ping-ponging between like a 20-30 point spread in the intraday action of the S&P. And you're likely going to continue to see that. If you have a massive drop in the markets, then that is going to require some new information to be fed to us. So something is either going to happen relating to recession data, something's going to happen in the bond market, or something negative would have to happen with tariff conversations in order for us to see that like really next strong leg down. Right now, that's not baked into the conversation. What is baked into the conversation is a contraction. And for the last 2 or 3 months, I mean, we have been saying that, the summer months tend to have way lower volumes. Those tend to be flattish. That could be the opportunity that you kind of grind down. But the reality is that to get downward moves, you do need an uptick in the VIX. And the VIX usually responds to lots of hedges coming in that are more than 30 days out on the S&P. So for that mathematical thing to form, you need people to be concerned not just about what's happening today, but what potentially could happen looking out. Now, events could be that people are expecting some kind of escalation in the Russia-Ukraine situation. Right now, nobody seems to care about Russia-Ukraine anymore, even though the situation has actually not subsided and we've had zero success in any of our conversations. And we are seeing an ongoing kind of strange rift in dialogues with because of tariffs, we have pushed China away from us and towards the European Union. But China and Russia have a very close relationship. If the European Union wants to get closer to China as a trade partner, then they are going to have to eventually work with Russia. But then that degrades their power in the conversation with Ukraine, which is very awkward. So how all that kind of unfolds is unknown. But the reality is that Europe is in an energy crisis, and no matter how much they want to beef up their defense, they're not suddenly going to beef up their defense in order to go to an active war with Russia. They're not in any way prepared for that, not financially, and really not with ramping up all of their military grade weapons. And I mean, they just don't have the soldiers, the numbers, nothing. So it just feels like that's really far away, and that Europe will probably just end up, trying to negotiate their way out of all of this. But that looks really bad for Ukraine, and that looks bad for being a conversational partner with the United States, because essentially the US has been the supplier of weapons for Ukraine. And if they suddenly look like they're starting to support Russia, then it just doesn't make sense either. So this is like a weird relationship that is disempowering everybody, but no one seems to be paying attention to it because it's not that big of a deal in comparison to all the other things that are going on. It seems that there's also some kind of rift between Netanyahu and Trump, and essentially the United States is trying to negotiate with Saudi. Obviously, the United States was able to get Saudi and the OPEC countries to bring in a significantly greater amount of gas into the market, and that has significantly helped oil and gas prices to come down quickly, which has helped basically cause this negative inflation spike for us, or inverse of spike. And thank you very much. I appreciate the Happy Mother's Day from all of you guys. Happy Mother's Day also to the mothers on the call, and grandmothers and aunties and so forth. So right now the question is, well, what did the United States give Saudi in order for them to basically tank their own economy? And then the other question is, then what does Israel get out of this? Because one of the big things that Israel has wanted is for Saudi to normalize their relationship with Israel, and for that normalization of the relationship with Israel, then everyone would support this nuclearization plan of Iran. So it's like this kind of like four-way chess that everybody has going on. And right now, because no one seems to care anymore about Iran, Israel seems to be really pissed off, because it is in Israel's best interest for the United States to go to war with Iran. And actually, the United States has nothing to gain by going to war with Iran. It is just, it's going to be a nightmare. America has gone to war with a lot of people over the years, and none of it has done anything positive for the United States except damage our reputation and cause us to spend massive amounts of money. Now, of course, those in Congress that have really close ties with defense contracts and companies that basically sell weaponry, they are all for going to war, because obviously that makes them money. When you are the capitalist of war, peace is never monetarily beneficial to you. But the reality is that Iran wouldn't have to do very much to destabilize Israel more than all of this hobbabaloo has already destabilized Israel. So, Trump is not so silly as to think that, yes, we should go to war. And we have this ongoing situation, this ongoing genocide in Gaza, and we have this failed ceasefire peace deal in Russia and between Russia and Ukraine. And even though very few people talk about it, the situation in Congo, the civil war in Congo, is extremely problematic for the entire tech industry, which the tech sector is one of the only sectors that has continuously outperformed the S&P. So, and of course, consumer discretionary, but things like Tesla and Amazon also require a lot from Congo. So even though maybe nobody is talking about Congo, it is not a great look for our economy. So this is not the moment where suddenly the United States should be like, and let's go to war with another country. So, Trump is trying to put pressure on their allies and say, if you basically trade with Iran, we're not going to trade with you. We'll, whatever, trying to do all of that. But it is, it's not sufficient for what Israel wants. It's insufficient probably for what Saudi would have wanted before. But the thing that I think that Saudi wanted is they wanted the value of gold to go up. And since gold is valued against the US dollar, the Gulf countries who own a massive amount of gold, they stand to gain a lot by the dollar weakening. By the dollar weakening, it essentially means that there could be a price target on gold of up to $10,000. Now, not today, but over time, if the dollar continues to stay depressed, then that strengthens the value of gold that is held by the Gulf countries, and the Gulf countries hold a massive amount of gold. So this seems to be maybe what like the give and take was behind closed doors, because the United States would have had to give up something in order to get the OPEC countries to agree to basically depreciating their number one commodity, which is oil and gas. But Trump needed that in order to get the win on inflation, because Trump and his team are not stupid enough to think that tariffs won't cause reflation. And so they needed to get inflation down as quickly as possible to avoid tariffs giving it too much of a spike, so that they could continue to pressure the Fed to take the Fed funds rates down. So I think gold was kind of the weakening dollar, and gold was the exchange that they made with the OPEC countries behind closed doors. So that means that even though gold has had this like massive crazy run, if that is in fact the truth, then it means that gold still has upside potential. How strong is that reasoning that I would like go out and buy gold at these levels? I mean, we were calling out gold from like more than a year ago. So people weren't buying gold back then. It's difficult to, you're really at the top of the range. So I would say that you can buy gold if you are a phenomenally good charter, and you can see where those key levels are, and then try to like slowly continue to scale in like on the upward move. But just to try and buy from right here and you don't have some good charting skills, you could end up just buying too high a price, because we are up here, and any kind of move towards to the 4,000, I think that would take time, just because we've already made such a strong move. And as always, I say silver is the laggard to gold. So if you've totally missed gold, then you might want to look at some of the other metals, but they have also been moving. Copper has had a breakout move. Silver also has been moving quite strong. We were calling out SLV when it was like 20. I think the first time we bought in, it was like 18. So, I mean, it's already had this move to 30 is a big move for silver. But in comparison to gold, it hasn't made a move at all. And it's the laggard. So, that is your kind of time, could be your better risk reward setup. So we've talked about CPI and PPI. I think that there are some key areas of inflation that everybody has to be paying attention to. And that is really going to be the housing sector. I think that is an area of the market that tends to be quite difficult, because just rates are so high, mortgage rates are so high that few people can really afford to buy new homes. So you have a lot of homes that are just sitting on the market. And of course, people are concerned about potential layoffs and downsizing just across the markets. So, people who are already locked into a mortgage, or have already been paying down their equity, even if maybe the house is a little bit more house than they wanted, it doesn't really make a lot of sense for them to try and downsize right at this particular moment. But the reality is that how fast are rates going to come down? That's yet to be seen. A massive amount of that has to do with the strength of the banking sector, and then how willing they are to continue to expand credit into tightening liquidity. So it's really important to banks that they can see that there are enough US dollars moving around to give them the liquidity to basically lend. Because even though banks lend like 1 to 10, they do have to have the one. And, liquidity is drying up. You can see it in all aspects of the shadow banking sector. The shadow banking is not a nefarious term. It just means all of the US dollars that are being traded outside of the US jurisdiction. So it's also called the euro dollar system, but that whole kind of euro dollar system has expanded a lot over the last 10, 20 years. That's where a lot of US dollars normally sit. And they're starting to find just the movement of US dollars very tricky. And that just means that banks are unable then to lend aggressively during those periods, or they're going to ask for higher interest rates to guarantee that they get their payment back. Because if they don't get paid back, they don't have any way of kind of hedging themselves with other plays because of the kind of the ease of money. So you have all of that. The other thing is that pushes a lot of people to take much higher risk borrowing. So this is where you start to see things like junk bonds start to become really actively traded. When junk bonds are traded faster than corporate grade bonds, like those A and B class bonds, you have to start feeling cautious, because that was really a big signal before the last kind of market correction in 2020, during 2022, was the fact that junk bonds were like traded at a very fast speed, and very low duration T-bills were just being constantly traded. But the more substantive kind of 10, 20-year bond and then corporate grade bonds weren't being traded as quickly. Or they were being forced to trade with really high interest rates. And because of the fact that like just people didn't feel certain that people would be able to actually repay those guarantees over a long period of time. Now, we have some serious market issues that are going to be coming up in the summer. And the reality is that because of just the high Fed funds rate, Yellen was really gaming the system by only mostly auctioning very low range bonds. So low range in the sense that very low time duration. So focusing on 6-month T-bills, 1-year T-bills, 2-year bonds. And that basically means that all of those bonds and T-bills, they come up for refinancing very quickly. And as you do that over a longer period of time, it means that the number of very short duration bonds starts to rapidly increase, because you get this convexity factor where somebody that had a 5-year bond, and then the next person that had, as those bonds are rolling off, if somebody rolling off a 5-year bond takes a 1-year T-bill, and then 1 year later, all the people that had 5 years that are now coming to expiration roll it into 1 year. Now you end up with like double and double and double. You just keep, flipping that number really high. Right now, the amount of debt that has to be refinanced is massive. And yes, Doge did some few good things. And yes, tariffs have brought in a little bit of extra cash. But we are looking at doing tax cuts, and we're looking at expanding the budget. And we have all the debt to refinance. So the reality is that the US is going to have a serious summer ahead of it. And here's the thing, right? Trump knows that we're like 12 months from campaign season starting for all of his bros in Congress. If these people mess up this summer and the summer holidays, and they don't figure out what they're doing with budgets and finance and refinancing their debt, and they agree to expand the bill and expand the budget, they're going to have some massive problems. It is not going to be a funny time for anybody. and it's going to be very stressful, and that could cause some new waves in the US markets because nobody likes that kind of budget uncertainty. So, but that's still some ways off, and a lot can get done between now and then, especially if Trump is flexible. So we just have to see what, where that all gets to. But all of that has to be on our radar because the bond market has its own volatility index. It's called the MOVE index, and that has been extremely high, which is not great. Bonds should move like molasses. They have been moving like disco dancers on crack. I don't know what's happening. Those bonds are moving way too quickly, and nobody likes that, and it's not good for stable markets. So these are all things that we have to pay attention to. They're not falling apart today, but they are like just on the horizon. So I saw a report that gold could go to 5K by the year's end. I wouldn't bet on it, but what do you think? So yeah, as I said, I think that, if you're looking out over, this, not just to the end of the year, we could very easily see gold to 4, 5, 6, 7, 8, maybe even 10K. But 10K would be like a few years out, I'd expect. But yeah, it's really all about what's happening in the wider economic dynamics. Because if the dollar continues to weaken, gold will continue to accelerate to the upside for sure. I just began studying mortgage, going to do my test after and see, I'm more interested in knowing how it all ties to the market. Yeah, so the thing is that, real estate is only a good investment when you can get housing prices obviously at a decent rate, but also when you can borrow money cheaply. And when mortgage rates are too high, it's difficult for people to continue to borrow. Now, this handicaps them in multiple ways because for a lot of people, their entire wealth is sitting in their house. So for them to be able to borrow to even do other things becomes really difficult. Then if people can't borrow against their home equity line or whatever, or extend their home equity line or, home credits, depending on whatever their mortgage situation is, then people are going to have to look for money from elsewhere. And oftentimes people do start to borrow against their own pension. And when they do that, obviously then it's not bearish for markets. It just creates a consolidation because normally you constantly have these end of month rebalancings where you have a lot of pension money coming in and 401k money coming in and things like that. So if you have people taking money out of their borrowing against their 401ks or Roths or whatever, and you just have the money coming in, it just creates this kind of flat activity. You don't get that bullish grinding upwards. The other thing is people can't move. And when people can't move, then it means that the people that actually need that housing for that location have to start, doing all kinds of other finessing to figure out just like the general life balancing. And that can cause a lot of extra costs for families. Because let's say, for instance, you get a new job, you want to move near the job, but you can't because there's no housing. Either you're going to be living really far away, which means that you're commuting more. You're starting to think about extra daycare costs, or you're thinking of extra driving time, or you're having to, maybe rent an apartment while you wait for your house to sell, but nobody's buying. And then you're kind of caught up in all of these kind of strange actions that end up costing you significantly more cash month to month. And then of course, if you're part of the belief that you should be saving like a certain amount of your paycheck should be going into the stock market every month beyond just your pension commitments, well, then you won't obviously be doing that. And you could be taking money out of the market in order to pay for other necessities. So, yep. Growth just becomes much more difficult. Yeah, let me know if you guys have more questions. Please put them down in the chat. Damage has been done with these tariffs. A multiple contraction is coming. Risk assessment requires the S&P should have a forward PE of 16 to 18. Yeah, that's true. And that was Warren Buffett's rule. He really bought everything when the S&P got that, the forward PE ratios got that low. Now, because of the change of the value of the dollar and the amount of foreign investment that continues in the US stock market, I don't know that we ever could get that low again without having like a massive recession, which would mean like that we take like a 40% hit or more in the S&P. Just the way that the Fed can print money and the way the government can stimulate, I think that they will get active before they see the stock market kind of blow up, just because people can't retire and people can't stay in retirement. And it puts a massive amount of pressure on just like social structuring. So they really don't want that to happen. They don't want Americans to lose confidence in their market, and they certainly don't want foreign investors to lose confidence in their market. And a 16, 18 PE, forward PE would guarantee that. So I think that they're more likely to respond faster than letting it get all the way down to that level. How does the bond market control the Fed? So the Fed controls the bond market. So essentially when the Fed funds rate is at a certain level, then usually that kind of sets a precedence for where the 10-year bond is, and then everything else kind of settles in between that level. But of course, if the bond market sees that if bond buyers see that actually there are aspects of the market that maybe the Fed cannot respond to but are inevitable, like inflation going up or something like that, they then can auction the bonds to a higher rate than what is actually where it's currently at. And so that's what's happening, is that because of the fact that people are highly concerned about inflation, bond auctions have continued to push bond yields higher. The only way to kind of push bond yields lower is to get the Fed to drop the Fed funds rate, because then that basically shifts all of the yields just down incrementally with the Fed funds rate. And right now, the futures market is projecting that the Fed is going to cut more than they are saying. Part of that is because of inflation. Part of that's because Powell's term is coming to an end, and they expect that no one is going to be as hawkish as Powell is right now. Powell is generally very dovish. He's just been hawkish in the most recent years. So, yeah. Great questions, guys. Ask all the questions. So this week also we have some key earnings coming out. And again, I think that, we're going to start to see, I'm just looking over at my charts. I'm not looking away from you guys. One company that's coming out that I really like is ANET. That's something that you guys can look at. I won't go into all the details, but, they actually already had their earnings this last week. Why did I think that was this coming week? Anyhow, well, their earnings were good. They did kind of gap up, but they're digesting at this, at this current gap up level. And I think that if you look out the next year or two, it's a great company. I think that they have a lot of potential, especially once things start to even out. I think that, this is a company, I would not be buying long calls. What I would do is sell puts at key, and maybe even a little bit aggressively. So normally I don't recommend selling puts higher than like the 15 delta. But if I really like a company and I don't mind owning the shares, then I might try to sell a little bit closer to the money. And the reason is because if I'm selling at a 20 delta or a 22 delta, I still don't have a really high chance of getting tapped. but I'm taking in a much more aggressive credit so that when I get tapped, I've already like banked a certain amount of cash that I feel justified, putting towards shares of ANET, where I don't want to like just go out and buy shares of ANET at $86. I do think maybe a nice price is somewhere around the $78 mark. I would not be doing, look, guys, if all you are doing is buying long calls, like I'm rooting for you because we're Instagram friends, but I don't think that the stars are aligning for you. If I was, I don't know what those people are that like have those metal things and then they like say, they ask questions like, do you think that the market is going to benefit long calls? I think it's like that when it says no. My fingers are pointing to the opposite sides of the universe. I just don't think that the spirits are giving me solidarity with the idea of buying long calls. I mean, obviously, if you're like trading very specific things in short duration and you know how to scalp, do long calls. But I would suggest this is a really good time to like learn how to utilize other strategies. So, like right now, we talked a lot about Google. So if you guys had attended a couple weeks back when we were talking about Google and Google was running up, and my big thing was I did not like the way it was just sitting like on the weekly chart, it was sitting below those moving averages, the 20 and the 50. And the thing is, we had a massive gamma squeeze down to the 120, the 145 into earnings. And that was like 3-4 weeks ago. And I signaled in the group, like, this is very strange. But like normally you don't get gamma squeezes to the downside. You usually have them to the upside. And you can see if it's a strong or weak setup. So you kind of know, okay, like maybe an institution was trying to do something and the chart just isn't setting up for them. But, we had a massive gamma squeeze down to the 145, which I was like, okay, that's not looking great. And then, we moved down to the 145. So some people did like put calendars and stuff, to take advantage of that drop. Look, Google is a great company. And at the moment, it's really close to it's not too far away from its 200 moving average. So, if Google's a company that you want to own, you could be selling some puts below that 200 moving day average just because that's like a massive institutional buying level. So you're unlikely to get tapped, but because the volatility on the stock is so high, because of the fact that it's moving down, you can get some massive credits for selling down there. So sometimes it sounds strange to be like selling puts when things are moving down. But the thing is, when the price is moving down, the VIX is really high and the volatility on that particular stock is usually really high. And so even if you're selling a put, you could be selling a put like 25 points away, which is just statistically unlikely to get tapped. Especially when you've already had such a major bearish week. Normally you'll at least get some kind of digestion or some kind of mean reversion. So, that could be a really great stock to be selling against the bottom. Yeah, I Google has a lot of competition. And honestly, like, people love it and they're like buying, want to buy shares and things like that. But I think that, they have a lot that is that they're competing against. But it's also a mega cap company. They have the money to do the work. I just don't know that they're always like exerting their energy in the right place. So, I mean, I'm not a fundamental analyst, so I don't want to make it sound like I understand all the ins and outs. But if you wanted to make money trading Google, I would say the way to do it would be to either sell short puts or to even sell a strangle, which would be both a short call and a short put. A lot of the mega caps, a lot of the tech companies, they're back in their downtrend. This is exactly what I was saying for the last couple weeks, that you don't want to just see a peak above a major downward trend line and then a failure. So you have a lot of companies that kind of just peaked above or just got almost to that downward trend line and then failed from there and went back below all of their moving averages. You want to be cautious of that. The fact that, and one of the other things that is, and this is something we talk a lot about when we're trading and people are asking me about charts, is that when you have underlyings that tap all the way back into the origin of their move. So if you like zoom out of Apple had this like massive area at the 170, and that was kind of the inflection area where it had a really strong pullback. And then that's where it turned around and then put in all those new highs. And it came all the way back to the 170. And usually if you get a move back to the origin of the original massive upward move, and you don't see like a powerful move out, you don't see imbalances that are held, you should be suspicious of that up move. And Apple gave us like 2 imbalances, and then gave it back, gave us an imbalance and a price, this like price gap, and then failed and gave it all back and then came back down. And then it slowly tried to grind up. That's ugly price action. That price action by itself should tell you, this ain't it. This isn't it's not that it's, and I'm not saying that like you should never buy Apple. I'm just saying that this is not what a chart looks like when it is going to push through a massive gap down, break a downward trend line, move above all of the moving averages. This is where you're just going to get more sell the rip kind of activity. Nvidia's kind of in a similar situation. It is above most of the moving averages. It is giving much more natural kind of, bull flags. But if you notice, one of the rules of a bull flag is that the poles, so for those that don't trade charting patterns, the pole and then your flag and then the next pole, every pole should be approximately the same length. So let's say that your pole was $10. The flag should never give back more than half. So if the pole is $10, your flag could be like $4. The next pole should be about $10 or maybe even a little bit more. So you see that there is acceleration in buying on those pullbacks. Apple gave us a massive pull down, gave us a massive move down, and then the first pump never got up against that resistance before having a pullback. Then it gave us another pull with a shorter flag, but then a very small pull. That to me is telling you we've tried too many times to get buyers to come in, and they're not convinced. Now, on Nvidia, I have a gamma squeeze to the 120. So I do think it is very possible that we continue to kind of get a move up into the 120. We hit that gamma level at like into OPEX, and then maybe we digest there a lot. But here's the thing, is that we have a massive resistance just at the 125. So Nvidia could just be grinding below that level until like new buyers step in and a new gamma squeeze is created. But you do want to be cautious of your positioning. Now, because of the fact that Nvidia hasn't yet had its earnings come out, volatility is still exceedingly peaked. So because of that, it is a very nice stock to sell against because of the fact that you will get a massive amount of credit because of that very high volatility, because of the fact that the earnings haven't yet come out. And I don't think that Nvidia is going to tank before earnings because usually people have really high expectations of Jensen. So that still gives me like the feeling that we can still, push up, but I am not liking this price action if I was expecting Nvidia to go to like the 140 in the very near future. This just isn't looking brilliant. I would have expected them to already be above all the moving averages, already to be digesting inside the 125. That would give me a lot of conviction that we're going to the 140. So let's look at NVO. So, NVO, Hims, Lilly, all those guys have been killing it on, with the whole like weight loss drugs and obesity drugs. But NVO has really, really struggled. I don't know if it's something in their business model. I don't know but here's the thing, right? You know that a bear market is over, or a bear trend is over when bad news on the stock comes out and it cannot make another leg down. Okay? So let's say, for instance, NVO has been just in this massive downtrend. Bad news comes out and the price just consolidates. That means something else is baked into the pricing that maybe we don't know publicly that is causing institutions to digest it, and then that's usually where you get really nice reversals. When you have a stock in a downtrend and you get good news and it can't get it up, that is not the relationship to be in. Find yourself a new friend. That's all I've got to say. But Hims has been doing great. So, NVO might not have been the play, but, Hims was amazing. And we were playing Hims. I was probably playing Hims a little bit too aggressively. I wish I would have just had naked calls, but I don't often do that because everybody can get naked. I think that, that's not really what we do at the Trade Speakeasy. We kind of show you how to express your trades with a little bit more, a little bit more nuance. So, yes, you were playing hood. You got us all playing hood. Come on now, Millennial Properties, you had us all riding hood, and we can thank you for that. So we have to give you your accolades, because I wasn't trading hood, and when you asked about it, I was like, hey, why are we not playing hood? So we did very well. And I think you also did mention him. So did Uncle Charles. So we had a couple people who were talking about it, and we did get long Hims, and very thankfully, because then it's been just hitting all of our levels. So if Millennial Properties said it, I promise you it's gonna happen. This guy's like Nostradamus. You just need him nearby to whisper sweet nothings in your ear. Your portfolio will be looking great in just 6 to 7 months. I promise. I don't know how he's doing his charting, but he knows when these things are going to move. So yeah, no, he got us into Hims, and I thank you for that, sir. Let's see. So Amazon has been doing exactly what we expected. We had pins at the 190 and at the 195, and it has already achieved those. So now we're looking to see if we can get some kind of next leg up. Wow, my chart did something really funny. It collapsed on itself. But so, Amazon is a nice chart, and Amazon is a perfect example of when you have a stock that has been grinding down, and then you have bad news come out. So that whole tariffs thing between Bezos and Trump, and that they were going to mark the costs because of tariffs and blah, blah, blah. And then that was some kind of political persecution or whatnot. The fact that Amazon didn't fail on the bad news, it did gap down, and then it just gave the entire move right back. That's when you know that things underneath the company, underneath the surface that may not have already been made public yet, are pushing a company into a nice reversal. That is called news failure. So, and this is a perfect example. When the market, another perfect example that looks exactly the way Amazon's chart looks right now. In October of 2022, at the FOMC meeting, Powell was still hawkish and the markets could not go down anymore. That was the signal to sell your kidneys and buy everything in the market. Why? Because when everything is bearish and you cannot make a new low, you know that other things are being priced in, and that is where you're getting really strong bases. It's called a news failure. That even though the bad news came out, the markets couldn't fail. So the news didn't do what it was supposed to do, and it gave you a reversal. Amazon came down to a really key support level at the 150, 155, which we talked about on our live, gave us a clean double bottom with a slightly higher other side, which is very bullish. And then it popped back up over its quarterly upward trend line. It broke the downward trend line, and now it is breaking above the moving averages. Also, Amazon, unlike the others, is that all of its moving averages were still above the downtrend, which means that it compressed really fast. And so the moving averages hadn't yet dropped all the way. All of the other stocks, all of the other mega caps, their moving averages were all below the negative trend line. So that means that all of the resistance is above it with no kind of support, institutional potential coming up underneath it. So, the fact that Amazon is holding this 193, they already had their earnings come out. So this isn't like a move based on volatility. I think that, this is looking much more decent than like Nvidia. And it is giving us, now its flags are happening a little bit too close. I would prefer that it would have a little bit more breadth in its upward move. But listen, this whole market is like shit-tastic. The fact that Amazon has been able to like hold its own, I'm not complaining. What type of trader are you? It's the first time tapping in. Great analysis. So I'm a gamma trader. So I look at all the open interest, and then I analyze where we're getting gamma squeezes, and then I like to position myself with multi-leg option strategies to to play those gamma squeezes. But and then I started to realize like people thought I didn't know how to chart because I read gamma. And so I was like, oh, well, maybe I should start talking about charting a little bit more, because gamma is a data point. And I trade gamma because even if a chart is telling me something and the institutional options position isn't sitting there, I'm willing to say the chart is beautiful, but institutions made me know something I don't know. And that's like I was saying before with Google. 3 weeks ago, Google had a gamma squeeze to the 145. So we were already expecting Google to have, this massive move down, but we didn't know why. We didn't know what the news would be. The news helped us explain later why institutions were already concerned about Google's positioning. So if I really like a chart, and let's say like Google looked like it could take another leg up, someone could have looked at the chart and argued that. I wasn't getting long from there because gamma was telling me institutions done doing something else. But, gamma's not perfect. It is a confluence point. So if you can partner gamma with the chart, then you kind of get this trifecta of like the perfection. So gamma is its own special Greek for our delta. I am listening. Yes, I love gamma. And I think that it's, once you kind of see how it works, it helps you game your own system, right? Like the whole reality is that you're trading against like really hardcore professional hedge fund traders. You like use all the tools you can. So, but yeah. I do look at the charts. I don't only use gamma in spite of what some people think, but then I also use really low risk strategies. So I don't often just do long calls or long puts. Mostly what I'm doing is trading risk averse strategies like calendars, diagonals, butterflies, iron butterflies, condors, things like that. Yeah, feel free to reach out to me. No problem. So yeah, I love sharing with different communities because you know what? We're all out here trying to make money in these markets. So why not help each other? Yes, the multi-leg, and that's the key thing. So one of the reasons people always ask me like, but if you know that something's going to move like 10, 15 points, why don't you just buy long calls? Look, I post my charts and I post my targets. If somebody else is like, oh, I'll just do a long call. Like I have people in my group that will never trade a multi-leg option strategy. Like they literally still till now, they've been in my group for like a year or more, and they only trade in a cash account. It's not even a margin account. They don't even want to have margin. And that's totally fine. And so they have to take my analysis and then set up their own long calls and long puts. And hey, sometimes those guys make a lot more money than I do because they traded naked. But that's not how I trade. And I tell people because I saw people take massive losses while they were trying to learn how to trade. And I just wasn't really into that. I didn't like seeing people, you know, somebody sent me a video the other day and the lady was talking about taking a $40,000 loss. And I mean, it was like a lady who obviously like $40,000 was a lot of money to her. It was not like somebody that's making, you know, hundreds of thousands of dollars a year, somebody on like a modest income. $40,000 is a massive amount of somebody's like retirement or savings or whatever. And you know, the person corresponding with them was like, oh, well, you should have gotten out sooner. And then you should have just taken the trade the other side. I was like, first of all, to make money, why are you risking $40,000 on a trade? If that's a lot, I mean, if you're telling me you make $500,000 a year and you know you already own your house and you're risking $40,000 on a trade without a stop loss and doing it naked and long and whatever, okay, this is not my business. But if that's a lot of money to you and you lost and you felt some type of way, one, you were trading way too massive a size, but you need to learn how to use strategies that don't require that much risk, because you probably could have actually taken a trade, or that person could have actually taken the same trade and the thing is, she wasn't even looking for that much money. She was looking for like a $1 scalp on her $40,000 investment. And I was like, if all you're looking for is a $1 scalp, you can get a $1 scalp on a multi-leg option strategy that might have even only cost you like $4,000 or $5,000 of risk maximum. And I mean, listening to her, I almost started crying for her. It's like she didn't lose my money, and I know that I can trade and get my money back. But you lost $40,000 on a trade, and you can't even explain well why you lost the money. I was just, that stuff make you feel it all over. No, I don't need to do that in my life. I've got enough excitement going on. I don't need that kind of stress. Oh, Jesus. I live near neo-Nazis. I certainly don't need any stress from the markets. That's all I got to say about that. So, yeah, so back to the markets. Yeah, got me going all different kinds of directions. That's all I can say. Palantir paid well. We had the squeeze to the 120. It got to the 117. But I am feeling some type of way of Palantir. Their CEO came out and started talking about Project Lavender and all the nasty it has been doing in Gaza. And I was like, no, Jesus, why? It's like you can't trade anything without like somehow like rubbing up against traffickers. Like, what is this? I just want to be able to participate in the markets. I don't want every single company I buy to be some kind of like some kind of moral, I don't know, S&M. I feel like I don't know. Am I dominating? Am I being dominated? I'm being whipped here. I don't know what's happening anymore. Everybody's like mean and bad. And why don't we just make stuff that doesn't murder children? Can that just be one kind of standard about companies? I would CEOs go, listen guys, we do a lot of bad things, but we don't murder children. Good. Okay, then I can go and participate. But now you feel like you're participating in the markets and you're getting involved in all kind of gangsta shit. I wasn't doing anything gang. Do I look like I'm a gangster? Come on. I don't even look like my own age. Yet I'm starting to do grown folk things. No, I want to keep my life simple, stress-free. So, but it paid us well into Alex's diabolical conversation about Palestinian people. So anyways, so it did well. It paid us well. I'm not feeling excited about trading it anytime soon. Okay, a sector that I think is going under the radar, which I think can do really, really well, and you guys know this sector because I talk about it a lot, is medical instruments and medical facilities. Those are two areas. So there are three sectors that kind of over time, they outperform the S&P. It's XLK, Y, and healthcare, XLV. And right now, healthcare has obviously gotten slaughtered because of everything going on with Trump and then everything going on with RFK and what those changes are going to look like and vaccines and A, B, C, and D. But if you look underneath the surface, the two areas that have continued to outperform inside the XLV, which has underperformed the S&P, these two sectors have continued consistently to outperform the S&P. And ABBV was one of them that we talked about last week, but medical devices and hospital facilities or medical facilities. So you can look at those two sectors and then find companies that you really like. You know that we have just been in love with ISRG. It did have a little bit of a pullback, but it has continued to do well. We've been actively trading ABBV, and there are many others. So you can look and see what kind of works in your, works for your portfolio, where you might be missing. But I would, at this stage, XLV as an underlying, I have to give Dre his accolades here, because he got into this when it was back at the 122, and he traded it all the way up to the 160. So he did great on that, and I'm sure that he started to take profits on this as it started to kind of roll over, and it has come back to the 132. Now, SLV has been trading in a zone, and so we've kind of tapped back into that zone. I will say this about ranges. When you are trading ranges, normally what happens is that you need to get a sweep of the bottom of the range if your last move out of the range couldn't sustain you to get in another all-time high. So basically the 160 was the all-time high, came back, tried to push back up and then fell back down. Now we have a head and shoulders pattern and we're right back inside the middle of this kind of range. If I really was in love with XLV and I was I need to buy it now, I wouldn't buy shares. I would just sell puts below the bottom of the range. So the 120 is the bottom of the range. You can sell below that or at the 120 or even at the 125. And if you get a sweep of the bottom of the range, you are at least going back to 136. Because that would be then the top of that inside range. So, if you got tapped in at 120, you'll go quite quickly to the 136, and then you'll make $16 on your 100 shares if you sold a short put. I would not be buying puts here because we are again inside the range. I don't think that we are inside the range. We could take a long time to get down to the bottom and then all that. So that's not really the sexy look that I'm looking for. But last time that we went to the 120, Then we got that really strong move to the 160. So you don't want to miss the bottom of the range, and you don't want to end up with this NVIDIA situation where the price gaps. In the pre-market, you have a massive move down, and then you never catch the best price because you never got tapped in. That's the benefit of having short puts, is that if the price comes back to you in the pre or the post market, you can get tapped into shares at really aggressive prices. And that's how I get shares at 90 on NVIDIA, is because I have short puts sitting there, and then I get tapped in, and when the price in the morning shoots up $5, I'm automatically up $500 plus whatever credit I was taking in for holding those short puts. It's a very easy way to play those extremes, but most of the time you're not going to get tapped into your short puts during the real market hours. So short puts is the only way to be able to get tapped in during that overnight kind of whiplashing. So yeah. Thank you guys. That is so nice of y'all. I really appreciate that. Yeah, I love you guys too. So that's really it for me. Really the thing, like I said, the thing you got to pay attention to this coming week is what is happening with CPI and PPI. We also have the Philly, what's it called, coming out. We have the Empire State Manufacturing and the Philly Fed Manufacturing. Both of those indexes are really important. They're going to show us if there have been any positive impacts on from everything that Trump has been doing. We have retail sales. But really the most important thing, unemployment claims. I personally think Chair Powell already knew about all of that information. So really, any information on unemployment or jobs that's going to be important is really going to be either at the very back end of May or at the very beginning of June. Now, on Thursday, Fed Chair Powell is speaking. Now, where is he speaking at? Because half the time he's speaking and it's at like some country club event doesn't really matter. Yeah, it's at a research conference. So he tries very hard not to reveal what the Fed is dissecting behind closed doors in those meetings. I don't think he's going to say anything that could explode the markets, but he could be cheeky, and that will just show that he's continuing to kind of pave his own way in this life, and he's not influenced by the pressure from Trump. I'm thinking we see a pullback sometime at the end of May, June. So yeah, we did talk about that earlier, more in depth, but yes, we are seeing that. So right now, the May OPEX is kind of holding us up here, but then after all of those options expire, just the low liquidity could be the cause of the next leg down. And then going into the summer, we have a lot of budget conversations, and we have massive amounts of debt to refinance, and we are trying to push through an expanding budget and tax cuts and blah, blah, blah. All of that could set us up this summer to see the next leg down if some of these tariff worries aren't kind of put behind us. China doesn't really give any shits about what the US wants to do. So China's under zero pressure to get this tariff talks underway. And they know the US is under a lot of pressure. And the reality is that China has communicated to their people that this is like a psychological war, and it is going to be a battle of mentalities. Who will stick it out longer? Will the Chinese people stick it out longer, or the US, or Americans? The pressure of inflation and maybe pressure on availability of different goods. But the Chinese people are ready to kind of weather the storm. That their sense of solidarity will allow them to lean into this more than Trump, because he knows they have elections in just over a year. So, and he doesn't want to lose any seats. He needs that to be able to get the rest of his agenda through in these 4 years. So I do think, Thursday will be important. But I think CPI and PPI, we need to see below, we need to see the details. So you want to look underneath the hood on that to see what's contracting and expanding. And then on Friday, just after market open, we do have preliminary consumer sentiment and inflation expectations. Inflation expectations are a lot more important to the Fed than consumer sentiment because the Fed doesn't want people to bake into their mind that inflation is going higher. They want the general public to have confidence that the Fed will do what they can to keep price stability, i.e. keep inflation low. So I think that that's going to end. That Friday report will be much more important than other times maybe that had come out. And it is OPEX. And so, that a lot of positions are rolling off. And if we don't see any down activity going into Friday, Friday could be a very strong pullback day. So, be aware of that. If we get a strong drop into the Friday, then Friday could give us a digestion or even just a pushback into the range. But the way the positioning is set up, we'll need this week to see a down move. SPY could hit 450 or 460. That is possible. It would only be possible if the recession data starts to compound. So for the NBA or whatever, the National Bureau for Recessionary Statistics, they have 7 pieces of data next to the 2 negative GDP quarters to declare a recession. And from those 7, almost none of them are at recessionary levels. They would need to adjust that. They would need to start reporting that they're starting to see red lights on on their different mandates, and then that could trigger the next leg down. But the market does need a new negative data point that isn't already priced in. And right now that, the market is kind of pricing in a lot. It's pricing in potential problems with Iran, ongoing pressures with Israel, ongoing pressures potentially with Saudi. If Israel doesn't play right with Saudi, ongoing pressures potentially with other tariff negotiations. Because it's already pricing in all of that, you need to have something really out of left field. I don't know, that Nicaragua is going to invade Panama. That would be worrisome for people. But, and that's just not on anybody's radar. But it would need to be something that's really additional in a big way to the conversation. All right, friends, I know that it is Mother's Day, and some of y'all are going out with your family, with your mothers or your wives or your partners or whatever. Go celebrate your family. For the mothers that are out there listening, happy Mother's Day to y'all. And I hope you guys have a great Sunday and you enjoy yourself. And the Trade Speakeasy is always open. And this has been like a gangbuster month for us. I mean, we tend to do really well, but we are just hitting it out of the park. So if you want to learn about any of these strategies, feel free to hit us up. You can find out more about the Discord in the link in bio at courses.tradespeakeasy.com. But we've enjoyed having you guys for our macro update, and I hope that you guys found it engaging. All right, friends, join. Exactly. We love to see all of y'all. All right. Bye for now, friends. Have a great weekend.